Hello everyone, this is Alexander Nikolov. Let's take a look at the foreign exchange markets, and today I'm going to start with the GBPUSD market, the British pound market, because this is the market where I see the most compelling opportunity right now. As you know, if you have followed our updates on the website, the rise from the May 2010 low is considered to be a diametric formation. Just to recap, this is the wave pattern that we've been looking for. This is a diametric formation, kind of a odd pattern, but this is the most likely scenario that is unfolding here on the daily chart. But the most compelling reasons which I see now for a trading opportunity come from the fact that the prices have once again retreated sharply from the 163.86 Fibonacci level. This Fibonacci level was calculated months ago, and as you know, it provided strong resistance several times during this rally from the May 2010 low. Actually, it provided resistance once, twice, 3 and 4 or 5 times actually for the past several months. Right now the pressure is shifting on the downside, and this together with the wave count that we've been following, once again this is the chart, the wave count suggests that the market should soon decline sharply in wave F of this diametric formation, and the minimum objective is a decline toward 155, 154 level. So right now, the daily chart displays a bearish message, not for the longer term, but perhaps for the next several weeks, and we will expect here a push lower toward 155 level. That's actually, again, the fact that the prices couldn't break above the 163.50, 163.80 level once, twice, actually several times. That's a negative message, and usually when the upside fails after so many attempts, a usually sharp move on the opposite direction happens. So this is the most compelling trading opportunity that probably exists for the coming week here, obviously from the short side. Now let's take a quick look at the other pairs. This is the euro-dollar. Here the rise from the March low begins to look corrective. As you know, we were looking for an impulsive move higher toward 145.70 level. This level can still be achieved, but obviously the move up is not impulsive. The trending conditions remain somewhat strong, but a weakening right now, as you see. There is still not a sell signal from the daily oscillators, but right now I'm not very confident that the euro will actually reach this 145.70 level. So a kind of a neutral stance here, because notice how the 142.75 level, actually 142.80 level, this is the top from late last year, from November. Actually this level provided strong resistance last week, and only if it is penetrated firmly on the upside, then the euro will be considered quite bullish. Right now the picture looks somewhat neutral here, and another move lower cannot be ruled out, at least toward 138, 137 area. Break below actually 137.20 will be a strong confirmation that the decline back toward 129, 128 area. This is the area of the late December low. Actually, no, this is the early January low of this year, is likely to be seen. So kind of a neutral picture here. US dollar against the Japanese yen, mixed messages here. The price pattern and the wave count strongly suggest a medium-term low has been reached, and a new long-term uptrend has just begun. The problem here is that this strong move up after the decline to 76.40 level was caused by a Bank of Japan intervention. So, as you know, I'm skeptical when a move up or down starts from a currency intervention, because the currency interventions do not have a lasting effect. Still, as long as the price is caught above the 80 level, the psychological support near 80, actually this is the most likely, that's the most important support here. So as long as it holds above 80.30 level, then the odds favor a move higher from here. And if the prices move above 83.80 level, then we will have a confirmation that a medium-term low has been recorded and a long-term uptrend has begun here for the American dollar. Right now, it's still the trending conditions are still suggesting weakness, because the prices remain below the 100-day, the 200-day moving averages. So we have a weak downtrend, but with the possibility that the trend has already reversed here. And finally, a very quick look at some of the other crosses that we do not follow quite frequently. This is the New Zealand dollar against the American dollar. Quite choppy price action here from the late 2010 top here. But so far you can see a clear ABC pattern to the downside, followed by a sharp move higher. So most likely my guess is that the New Zealand dollar has begun a new uptrend here, though the picture is a bit disturbing here, because notice how the prices slipped, though temporarily, but still they slipped below this important support level near 0.7360 level. But still, right now the pressure is on the upside here in favor of the New Zealand dollar. And finally, the Aussie. Here the picture is more bullish. If you recall from our previous video, we were somewhere here, and I was looking for a move higher to break above the important resistance near 1.02. Instead, the prices moved lower, but they found support above the 200-day moving average. And notice how the 200-day moving average, as well as the 100-day moving average, continue to move higher, and that's positive. That's positive. Suggests the medium-term trend remains on the upside here, and with the most recent break higher, the odds favor further gains. So the uptrend here is intact until proven otherwise. And what can change the uptrend? Actually, it will be only a move back below this this low here recorded several weeks ago. So in conclusion, the US dollar begins weak, looks weak against Australian dollar, New Zealand dollar, but it looks firm against Japanese yen and against the British pound, and kind of a neutral picture in Euro USD rate. So overall, a neutral stance. I have a neutral stance toward the US dollar, but there are good trading opportunities in some of the markets that we followed. So thanks for listening and watching, and I'll be talking to you again later.